All right, ladies and gentlemen, we are going to get started here shortly with today's 1031 Exchange webinar. Thank you all for joining. I'm going to be your host today. My name is Leonard Spoto, and I'm one of the owners of Asset Exchange Company. This is me. Before we do get started, I do want to make a couple announcements. First of all, everybody who is on this webinar is going to get an email when the webinar ends. Probably later this afternoon with all of the content. So you're gonna get a copy of today's presentation. All the presentation slides will be emailed over to you. And then in addition, we do record all of our webinars and we post them to our YouTube channel. So you can go and visit the YouTube channel if you want to share the presentation or if you want to review the presentation at a later point. The other thing that I wanted to mention is if you do have questions during the course of today's webinar, please do type your question in and it will pop up on my computer screen, and then we will be able to answer all of your questions as they are appropriate. Now, I know that Helen has a question that she has already asked. Actually, Helen's asked 2 questions already. And Helen, we're going to answer a lot of those questions that you're asking during the course of the webinar. And if you are still searching for answers, I will go through and answer all your questions directly. All right. So today's 1031 Exchange webinar is our basics presentation. So what we assume today is that you guys don't have any or you have very little knowledge about the 1031 Exchange process, okay? My company offers several webinars every month. We start off with basics and we do advanced classes, we do problems and pitfalls. So we do all kinds of webinars, but today's webinar is going to be the basics. So if you have been in the industry for 20 years and you've done 100 different exchanges, today's presentation is probably not designed for you. As I mentioned, we're going to go over kind of all the basics today, but we will touch on a little bit of advanced issues as well. Now, Stephen had mentioned that the sound quality is poor. And that may be a function of your internet connection. If you are listening to this webinar through your internet, you may want to turn off your computer audio and actually dial in via a phone. So I am using a phone to talk to you. I do not have computer audio enabled. I actually dialed the conference call number. So if you can use a conference call number, that will probably provide you much better quality of audio. All right, so we've got a decent group here, so let's go ahead and get started. Again, my name is Leonard Spoto, and I am one of the owners of Asset Exchange Company. We are a 1031 exchange accommodator. And as most of you probably know, when you do a 1031 exchange, you actually have to work with a 1031 exchange company. The IRS law, the tax code, requires that whenever you do a 1031 exchange, you work with a neutral third party to facilitate the process. So my company does not sell real estate. We do not sell escrow services or title insurance. The only thing that my company does is facilitate 1031 exchanges. And we've been doing this since 2006, although I've been in the industry for almost 20 years now. So those of you who have not worked with a 1031 exchange company know, again, that we are required. So you have to work with an exchange company when you do an exchange. And we serve 3 very important features. So number 1, we are going to hold all of the sale proceeds from the sale of your property. When you do a 1031 exchange, you are not allowed to touch the money from the sale of the property. If you touch the money, you are going to pay taxes. So we're going to make sure that that does not happen. When you close escrow, the escrow company will send all of the money via a wire to your exchange accommodator. Number 2, we are going to prepare all of the legal documents that are required. And then very importantly, we are going to make sure that you or your client is in compliance with all of the rules and regulations regarding Section 1031 of the Internal Revenue Code. So you get the opportunity to defer taxes, but very importantly, you have to make sure you follow the rules. All right. Now, I have someone else saying that they cannot hear me. And again, if you can't hear me, please dial in to the telephone conference call phone number. Sorry, I'm just going to make a note here to tell you guys all to do that. And I'm going to provide you guys actually. Okay, so Helen's having a hard time, but Helen's got to figure it out. Okay, so a little bit of information about my company. We are a exchange accommodator. Again, we've been doing this since 2006, although I've been in the industry for about 20 years. All exchange companies are required to be bonded and insured. My company has a tax attorney on staff who is a member of the California Board of Accountancy as well as the state bar. And then we do provide all of our clients audit support. No other company in the industry offers this, so it's very important when you are working with an exchange company, you want to make sure that they've got the bonding and insurance, because if they can't, they shouldn't be operating legally in California. You want to see if they have a tax attorney on staff, and then if they don't offer this, well, I don't recommend you use them. And the reason why is because your clients or you, when you do an exchange, you have a very high chance of being audited. And if you get audited, you're going to have to go out and get a tax attorney to help you prepare a defense. Now, if you work with my company, that tax attorney comes to you free of charge. So we can save you thousands of dollars if you're ever audited. All right. Now, we cannot represent you in tax court, but we can help you prepare a defense and help you hopefully avoid tax court altogether. So very important, and I promise that's the only commercial I'm going to give you for working with us. All right? So let's talk about Section 1031 and what it is. So Section 1031 of the Internal Revenue Code has been called the greatest wealth building tool available to investors. And it's been called that because it allows you to defer the capital gains tax when you sell your investment or business use property. So if you have a rental property, if you have an apartment building and you sell it and you have any profit in the property, you're going to pay about 33% as a tax rate between your federal and state taxes to the government. Now, of course, the only way you can avoid that is by doing a 1031 exchange to defer the tax, but you have to go out and you have to exchange into another property and you have to follow the rules. So we're going to call that. But Section 1031 routinely allows my clients to save hundreds of thousands of dollars in tax liability. All right. So it seems like we are having a lot of people with audio problems today. Can you let me know if you can hear me? So it says I am connected, and it says I'm talking. So can anyone hear me? Yeah, so we've got people that can hear me. So the people who are having audio problems, it's probably just your computer specifically, because we've got the bulk, probably 99% of the people who can. All right. So Section 1031, again, it allows you to defer the taxes on the sale of your investment property. Now, there are different ways in which you can complete a 1031 exchange, all right? And a lot of these ways you've probably heard about. Back in the olden days, back in the early days of 1031 exchange, the only way to do an exchange was simultaneously, where you sold your property and you bought on the same day, all right? That's called a simultaneous exchange, when you sell and you buy concurrently. Now, luckily, you don't have to do 1031 exchanges like that anymore. Now, of course, you can if you want to, but a simultaneous exchange when you sell and you buy concurrently is not the preferred way of doing exchanges. Okay, you can do that, but it is very difficult to line up all of your transactions to close concurrently. And luckily, we don't have to do our exchanges like that anymore. Back in 1972, the IRS and actually the tax courts allowed us to do what is called delayed exchanges, where you sell your property today and then you have 180 days to go out and buy replacement property. All right, the delayed exchange is the most popular form and the most popular method for doing exchanges. In fact, 95% of all exchanges done throughout the country are delayed exchanges. Again, where you sell and then buy in that order. All right, so chances are if you're going to do a 1031 exchange, it's going to be a delayed exchange. And this, ladies and gentlemen, is really what we're going to focus our conversation on today, because it is the most popular method for conducting the 1031 exchange. Now, again, it's not the only method, right? You can do a simultaneous exchange, although I don't recommend it. But there are two other forms of 1031 exchange. Now, these two forms are a little bit more complex and they're a little bit rare, right? Only about 5% of my clients are doing these more advanced exchange structures, but they are worthy of a quick discussion so that you know what they are. All right, so let's talk about first the reverse 1031 exchange. What do you guys think that is? Well, a reverse 1031 exchange is exactly what it sounds like. It is an exchange conducted in reverse. So instead of selling and then buying, you do what? Well, you do the opposite, or the reverse. You're going to buy first, and then you have 180 days to sell. So if you found a property and you want to make an offer today, and then you want to go out and sell something within the next 6 months or 180 days, you would structure your exchange as a reverse. But these are a lot more complex, they're a lot more expensive, and they are beyond the scope of today's presentation. I just want you to know that they are possible, but they're challenging. All right, so they're not as popular for my clients. And then the last type of exchange, or the last way that you can structure an exchange, is with what is called a construction or an improvement exchange. And this type of exchange allows you to use 1031 exchange dollars to build or improve a property. So you could sell $1 million property and buy some land and use the money from your sale to build on that land. Now, here's the real reason why construction exchanges are not really practical. And the reason is you have to use all of your money to build or improve within 180 days. All right, so you're going to sell something, and let's say you go out and buy some land. You want to use the leftover money to improve that land. Well, guess what? You got to spend the exchange dollars within your time frame of your exchange. And that, again, is 180 days. So in today's market, getting permits and getting contractors lined up might take you 180 days just to get your permits approved, right? So these exchanges, the reverse and the construction, they are available, but they are somewhat impractical. And so a lot of my clients don't do them. In fact, as I mentioned, most of my clients, 95% of my business is people doing standard delayed exchanges. All right? But know that there are different ways to structure your exchange, because your clients are going to ask you, hey, well, I heard I can buy first. Well, yes, you can. That's called a reverse exchange. And if your client wants to do that, you need to pick up the phone and call me right away, because we're going to have to walk through all the difficulties of how to structure a reverse exchange. And here's my phone number. I want you guys to put this in your phones right now. That's a terrible 3, but we've got 877-471-471. 1031 is my phone number, all right? So put that in your cell phones. When your clients ask about these different structures or even the delayed exchange, just pick up the phone and we'll have a consultation with you and your clients. All right? So different ways to do an exchange, but again, the most popular way is the delayed exchange, and we're going to talk about that in detail now. So how do you do an exchange? Well, there are four basic requirements to complete a successful 1031 exchange. So requirement number one is that the properties involved in the exchange have to qualify. Now, how does a property qualify for 1031? Well, it has to have been held for productive use in trade or business or for investment. Properties involved in an exchange also need to be like kind. And this is a source of confusion for a lot of my clients. Some of my clients call me and they say, well, geez, Leonard, I sold a 2-unit building and I want to do an exchange. Do I have to buy another 2-unit building? No. All right. When you do an exchange, the like kind requirement is very broad. In fact, you can go into and out of any type of real estate anywhere in the country, and as long as you are using those properties for investment or business use, they will qualify. So you can sell farmland and 1031 exchange into a rental home. You could sell the rental home and buy an apartment building. You could sell the apartment building and you can buy an office building. You have a lot of flexibility with two exceptions. All right. You cannot exchange property in the United States for property outside of the United States. So you can sell in California and you can buy in Texas. You can sell in Texas and buy in Missouri. You can sell in Missouri and buy in New York. That works. But can I go and do a 1031 exchange to Mexico? What do you guys think? Absolutely not. You've got to stay in the United States. All right. So that's one big caveat. The other thing is that when you do exchanges, quick flips are not exchangeable. So when you do a 1031 exchange, you have to season the property as an investment for at least 1, but preferably 2 years. Okay? Quick flips, something that you buy with a specific intent to sell, is not exchangeable. That is considered inventory. And inventory is not prohibited is prohibited from being exchanged. All right. So any type of inventory that you sell is going to be taxable. And in the real estate world, quick flips and actually development deals are also inventory. So you cannot exchange either a quick flip or a development project. If you are a developer or if you're a flipper and you want to do an exchange, what you need to do is you need to, as soon as your project is done, you need to rent it out. All right. I want to see rental income on your property for at least 1, but preferably 2 years in order for you to qualify for 1031 exchange. Now, why the discrepancy? Now, why do I say 1 or 2 years? Well, it's because the tax code does not specifically state how many days, weeks, months, or years the property must be rented out or used as an investment. Okay? But here in California, we have a fairly aggressive franchise tax board. So in California, the auditors definitely like to see 2 years, unless you've got some really, really, really compelling story. And if you've got a really compelling story, you might be able to get away with less than 2 years. But here in California, based on all of the audits that we've been through over the last 20 years, we know that California likes to see a 2-year hold. And if you've got that, they're not going to bother you. If you have anything less than 2 years, the auditors are going to say, well, geez, that kind of looks like a flip or inventory. Prove to me otherwise. And it is your responsibility then to prove to the auditors that your property was eligible. And that's hard to do if you've got a short hold period. Okay, so I like to advise my clients, be safe, rent your property out for at least 2 years, and you shouldn't have a problem with the auditors if you get audited. Now, Susan says, can you exchange and invest with family members in a vacation rental property? Absolutely. You can use, let's say you sell your farmland here, Susan, and you exchange into this beautiful home in Napa Valley, and you're going to use it as a vacation rental. That will qualify as long as you do not personally use the property too much. All right, so you want to be very careful, Susan, and everybody else. If you are going to use your property, you have limitations on how often you can use it. The rules for vacation properties is that you can use the property 14 days per year or 10% of the amount of time it was rented. So let's do an example. Susan bought this property in an exchange. It's a Napa Valley property up in the wine country, and she rented it out for 30 days. That qualifies for an exchange as long as she does not use it any more than 14 days per year or 10%, which is 3. So she gets to use it whichever is more. So she can personally use that property in Napa for 14 days and still be okay with the 1031 exchange rules. Now, let's say Susan rented that Napa property out for 300 days. Well, then she can use the property personally 14 days or 10% of the amount of time that it was rented, which is 30 days. So there, because she rented it for so many days, she's got more personal use allocated to her on that Napa property. All right, so those rules are solidified, and the government is going to look at how many days you personally use the property. And again, if you use it too much, they're going to disqualify you from having that tax break. You guys, I have to apologize. It seems like a lot of people have an audio problem, and I honestly don't know what to do other than to tell you guys to dial in to the phone number, and you shouldn't have a problem then. All right, so Helen wants to know, well, geez, can I rent my primary residence out for 2 years and then do an exchange? Absolutely. So Helen can move out of her primary residence and then rent it out, and then she can do an exchange. So that's going to work. Can she do the opposite? So someone wants to know, well, geez, I bought this property in a 1031 exchange. If I rent it out for 2 years, can I kick the tenants out and move into it? Yeah, you can. All right, so but you definitely want to rent the property out for 2 years before you do anything else with the property. Now, I think I answered Susan's property. Can you exchange? Oh, Susan's got another question. We'll go over that. And I see Han's got a couple questions, but we're going to go over those in just a bit. So rule number 1, ladies and gentlemen, is it's very important to make sure your property is qualified, because that's the first thing the government's going to look at. They're going to say, well, geez, let me see your tax returns. And what they look at in order to determine the viability of your exchange property is, geez, were you producing rental income from the property, and were you reporting it on your tax returns? And if you've done that for 2 years, they're not even going to question the validity of the property qualifying. All right, so if you can do that, that's a very good thing. If you don't do that, they're going to nose around in your business. They're going to try to disqualify the exchange and make you pay taxes. So first and foremost, make sure that you're using the property properly as an investment or as a business for 2 solid years. All right? Rule number 2. When you do a 1031 exchange, if you do not want to pay taxes, you need to remember 2 very important things. Number 1, reinvest your cash. And number 2, purchase property equal or greater in value. Now, if you're not paying attention, I want you to pay attention now, because this is a source of confusion for a lot of my clients. So let's go through an example. You are in contract to sell a property for $1.1 million. When you are doing an exchange, you can deduct your commission and closing costs to get to a net sales price of $1 million. That is the value that you need to replace in your 1031 exchange. So if you sell for 1.1 and you pay $100,000 in commission and closing costs, your exchange requirement, ladies and gentlemen, is $1 million. As long as you buy $1 million worth of replacement property in your 1031 exchange and you use all of the cash as a down payment, you are going to defer 100% of your tax bill. A lot of people get mad when I tell them this because they say, well, geez, Leonard, yeah, I sold for $1 million, but I only had $200,000 of profit. So what I want to do is go out and spend that profit and buy a $200,000 property. That doesn't work. Okay, the rules don't say just spend your profit. The rules that the government give us is, hey, move all of the cash over to the next property and make sure that you're buying property equal or greater in value. So you sold a building for a net sales price of $1 million. You need to buy $1 million worth or more of replacement property. Now, Helen wants to know, can she add additional cash? Absolutely. So Helen sold for $1 million. She wants to buy for $1.2 million. Can she add additional cash to the purchase? Absolutely. Of course you can. You can always add additional cash. What you don't want to do is take any cash out, because any cash that you take out and you put in your pocket is going to be taxable. All right? The government assumes that the first dollars that you take out are the profit dollars. And if you put those dollars in your pocket, you pay tax. If you don't want to pay tax, you need to move all of the cash into the new property as a down payment. So again, follow me here. I'm going to start with my original example. You're in contract for $1.1 million. You're paying $100,000 in commission and closing costs. That gives you a net sales price of $1 million. Now, most people have loans against their property, right? So you have to pay off some debt. So let's say you pay off $300,000 of debt. That's going to leave you with $700,000 of cash. All right? That cash, ladies and gentlemen, is your down payment. You have a $700,000 down payment, and then you're going to go out and either get a loan or contribute additional cash of $300,000 or more so that you're buying $1 million or more worth of real estate. That's how it works. Don't get mad at me because you didn't want to buy equal or greater. If you only wanted to buy $200,000 worth of real estate, the exchange is probably not a good option for you. Exchanges work when you purchase property $1 million or more. Now, Kristen says, well, geez, I thought it was 1.1. No, Kristen. Look, we have the ability here to deduct our commissions and closing costs. So I'm assuming you're paying commissions and closing costs of $100,000. So you can deduct that, but nothing else. All right. Now, Helen says, well, geez, I'm going to sell for a net sales price of $1 million, but I'm going to buy for 1.2. Helen has no loan on her property, so her $1 million of cash comes over, and she's got $200,000 that she needs to add. How does she do that? Well, she's going to wire it directly to the escrow company. No need to send the money to me. You're going to wire the extra money to the escrow company for the purchase property. All right? So again, ladies and gentlemen, rule number 1 was make sure your property is qualified. Rule number 2 is purchase property equal or greater in value and use all of your cash as a down payment. Rule number 3 when you do a 1031 exchange, and everybody knows this, we've touched on this just a bit, you have a time frame. Right? You have a time frame for doing a 1031 exchange, and it's very, very important that you follow the rules and you make sure your time frame is met. Because if it's not met, you're paying taxes. So what is your time frame? Well, your time frame for doing an exchange is 180 days. You're going to sell a property, you're going to close escrow. That is the start of your 180-day time frame. You've got 180 calendar days to go out and complete the purchase of your replacement property. You can't get an extension, and if you close on day 181, you're out of luck. So you sell a property, escrow closes, your time frame starts, you need to buy your replacement property on or before day 180. Now, ladies and gentlemen, that's 6 months. That's plenty of time to go out and close on property. Most of my clients do not have a problem with the 180-day requirement. Most of my clients, when they stress out about their 1031 exchange, it's because of what they have to do on day 45. On day 45 of your 1031 exchange, you are going to have to submit an identification letter stating all of the properties that you're thinking about buying. So yes, you do have 180 days to do your exchange, but in reality, you need to know what you're going to buy on day 45, because day 45 is when your identification letter is due. And again, ladies and gentlemen, on day 45, you're going to submit a list of all the properties that you're thinking about buying. So this is an example here of what an identification letter looks like. You're going to fill it out, and you're going to put on this letter every property that you might want to buy. And guess what? You can't put 300 properties on this letter. The government gives you rules on how to fill out this letter. The most common rule when you fill out this letter is to use what we call the 3 property rule. The government says, okay, well, when you fill out your letter, if you use the 3 property rule, you can fill out the letter and nominate 3 properties, but only 3 properties. Now, of course, most of my clients, when they do an exchange, they sell 1 property and they want to buy 1 property. And then what they do is on their letter, they list their first choice, and then they go out and they put 2 backup choices. And that's a good idea, okay? Because on day 45, when you submit your list of 3 properties, you are then locked in to that list. You cannot change it after day 45. So if your first choice gets sold to someone else on day 46, you can't replace it. You have to go to the second choice. If your second choice burns to the ground on day 47, you cannot replace it. You have to go to the third choice. Now, hopefully you can close on the 3rd property. But if you can't, guess what? You can't replace it, and you do not have a valid exchange, and you end up paying taxes. So everybody asks me all the time, well, geez, what's the worst case scenario in my 1031 exchange? Well, the worst case scenario is you just don't complete your exchange and you pay taxes. It's not the end of the world. All right? Now, you might owe hundreds of thousands of dollars in taxes, and yeah, it's a huge bummer, but it's not the end of the world, right? When you make money, you pay taxes. If you don't complete your exchange and you don't follow the rules, you pay taxes. A failed exchange doesn't come with any penalties. You just pay your taxes like you normally would. All right? So don't go out and buy a terrible property just to complete your exchange. Make sure it's something you want. Do your homework. The 3-property rule, again, allows you to buy up to 1, 2, or 3 properties. You can nominate these properties on your identification letter on day 45, and then you can buy any or all of them, but only these properties. So, ladies and gentlemen, when you are doing your 1031 exchange, what I really want you to do is use the first 45 days very wisely. You can go out in the first 45 days and make offers on 200 properties, right? It doesn't matter until day 45. So go out in the first 45 days, make offers on as many properties as you want. Hopefully you get into contract and day 45 is just a formality because you already know what you're going to buy. You're in contract. So nominate that property and then 2 backups just to be safe. All right, so day 45, very, very important, but most of my clients don't wait until day 45. They're going out making offers well before that. Most of my clients are in contract on the property they want within the first 45 days. Now, some of you might be thinking, well, geez, I'm going to sell a property here in California for $1 million, and I want to go to Texas. And in Texas, I can buy a lot of real estate for $200,000. So I want to buy 5 or 6 or 10 properties. How do I do that? Well, you're not going to use the 3-property rule when you fill out your identification letter. You're going to use the 200% rule. Because the 200% rule does not limit you on the number of properties you can identify. You can go out and identify as many properties as you want. There's no limit on the number of properties. Unfortunately, however, there is a limit on the value. The value of all of the real estate that you identify cannot exceed 200% of what you sold. So let me give you an example. Remember, Kristen, we sold our property for $1.1 million. Now, here is where we're going to use the $1.1 million value. We're going to double it, and we're going to identify $2.2 million worth of Texas properties. That could be 6, 10, 15 properties, right? Texas property, this might be $100,000, this might be $200,000, maybe this is $350,000, maybe this is $125,000, right? You can nominate a bunch of small properties, and as long as the total value doesn't exceed $2.2 million, you are good to go. Now, which of these methods for identification is more popular? Do people use this rule more, or do they use the 3-property rule? What do you guys think? Most of my clients will use the 3-property rule because most of my clients are selling 1 property and buying 1 or maybe 2. It's very rare that clients go out and buy a bunch of small properties in Texas, but it does happen, right? I had one client buy 35 properties, sold 1 in California, bought 35 properties. And when you do that, of course, yeah, you have to use the 200% rule. But most of my clients are going to use the 3-property rule when they fill out their identification letter. Does that make sense? Because really, 1031 exchanges are that simple. You're going to, number 1, make sure your property is qualified. Number 2, you're going to reinvest your cash and purchase property equal or greater in value. You've got to get your exchange done within 180 days. And what do you have to do on day 45? You have to identify. All right. Those basic guidelines are going to get you through 95% of all exchanges. And then when you have other issues that come up, you're just going to pick up the phone and you're going to say, well, geez, Leonard, I've got something funky going on. How do I deal with it? Well, when you do that, I'm going to have answers for you because I've been doing this for 20 years. And there's no question you can ask me that I can't answer. I guarantee you that. I've been doing this forever, and I've seen every single variance, every single circumstances that could come up. So I'll have a solution for you, I guarantee it. Now, I'm going to take a couple minutes before we segue into our next portion of the presentation to answer some questions. So Susan wanted to know, can I invest with a family member? Yes, Susan, you can, but you need to be careful, okay? Because Susan sold a property here for $1 million. She wants to buy replacement property with her family members in an exchange. But we know from the tax deferral requirement rule that Susan needs to own $1 million worth of real estate in her exchange to be completed. So what that means is that Susan, if she buys with her family members, her ownership stake in the property, if it's 50%, it needs to be worth $1 million. So that works well if they're going to go out and buy a $2 million property, because she can own 50% and then her partner can own 50%, and Susan has replaced the value of what she sold. All right, so your percentage, Susan, of the new property needs to be worth equal or more to what you sold. So if Susan sold for $1 million and Susan goes out and buys a new property for $1 million, there is no room to take on a partner, right? She's going to have to go up in value to take on that partner. So Helen says, well, geez, what happens if the property identified is different from the property you bought? Well, that's a problem. You don't have a valid exchange, and you're going to end up paying taxes. Elizabeth says, when will we be able to request the form for the identification letter? We will provide that to you, Elizabeth, when you are our client. So you enter into a 1031 exchange with me, and we're going to provide you with all of the documentation you need to properly do your exchange. All right, Han's got a question. So Han wants to do an exchange into multiple properties. So she's going to sell one property and she's going to buy a bunch. That works, right? And you can identify either 3 or use the 200% rule. But Han's question is, well, how do I charge for that? Well, my fee is $750 for the property you sell, and then $250 for each property that you buy. There are no miscellaneous charges, no wire fees, or any other expenses that you will incur. Again, $750 for the sale, $250 for each property that you end up buying. We only charge a fee if and when you close escrow. All right, Han's got another question. Han owns a property in an LLC. He wants to know, when he does the exchange, does the LLC have to buy the replacement property? And the answer to that is tricky, because when you do an exchange, the taxpayer who sells has to be the same taxpayer to buy. And sometimes LLCs are their own taxpayers. And if that is the case, then yes, the LLC that sells needs to be the LLC to buy replacement property. However, if the LLC does not file its own tax return, then it does not have to be the same. All right, so very good question, Han. And if you need further explanation on that, shoot me an email after the presentation. All right, so let's talk about the 1031 exchange and the steps involved. All right, I'm going to walk you through a typical 1031 exchange. First thing that's going to happen, you're going to list your rental property for sale. You're going to go out and get an offer and negotiate and eventually accept an offer. And then you're going to open escrow. Okay, that is when you're going to call me, because once you've opened up escrow, you're going to have 30 days before you close, but I need to coordinate with the escrow company. I've got to prepare documents, and I've got to provide the escrow officer with wire instructions, and I also need you to sign all of my documents. All right, so you need to get me involved, hopefully right when you open up escrow. If not, I need to be involved before you close escrow, because once you close escrow, there's no exchange, right? If you touch the money, if escrow closes and records and sends you a check, you are paying taxes. So you cannot do an exchange unless you've set up the exchange account with me prior to closing escrow. All right, so get your exchange set up prior to the close, and then once you close escrow, the fun starts. Okay, that's when your time frame is going to start, right? The close of escrow, that's day 0 of your 1031 exchange. And then at that point, the escrow company sends me all of the money from the sale of your property. So they're going to wire the funds to your 1031 exchange account, and I am going to issue you a receipt of funds notice. So you'll get a document that says, hey, the exchange company is holding $227,000 on my behalf. You're going to use that, obviously, to go out and show your lender that you've got money sitting in the exchange account. And then the very next thing you want to do, if you haven't done so already, is go out and actively start looking for replacement property. Go out and make offers on 200 different properties, 300, right? Do your homework, figure out what and where you want to buy. And then if you need to, on day 45, if you haven't already purchased and closed, if you need to, on day 45, you're going to submit your identification letter, right? And when you get in contract on one of those properties, you're going to open up escrow for the purchase property. You're going to let me know that you're in contract because I am holding your money. So I am going to release some of your money for your deposit on that new purchase property. I'm also going to prepare another set of legal documents and send them to your purchase escrow. And if all looks good on that property and you've done your inspections and you want to move forward with the purchase, we are going to wire out all of the remaining dollars in your exchange account so that you can close escrow and complete your exchange. Ladies and gentlemen, it's that simple. You're selling a property and you're buying a new one. Not very difficult, right? From a practical perspective, it's an easy thing to do. You sell, you buy. Now, of course, it may be hard to locate the exact property you want to buy, so you got some homework to do. And you might have some weird tax issues that come up. You might have an LLC involved, like Han did. And so we might have to have discussions about that. You might need to do a reverse exchange, so we'll have discussions about that. You might want to buy your replacement property from a family member. And I might have to tell you, that's not allowed. Okay? So there's a lot of nuances that go into the 1031, but my team has been doing this for 20 years, and we're going to make sure that all of the I's are dotted and the T's are crossed. What we want you to worry about is get your property sold, go out and find something you want to buy. Okay? We'll make sure from a tax perspective that it's possible. Now, a couple questions that commonly come up during these presentations. Number one, my client bought a rental property 11 months ago, and now she told me she wants to sell it and do an exchange. Is that possible? Well, what do you guys think? We know that I told you I want you to hold the property for at least 1 to 2 years, and this person has only owned the property for 11 months. So can they exchange it? Well, it depends, okay? I say yes here, but it's just really aggressive. Okay, your client should have a very compelling argument as to why they have such a short hold period. Okay, did they buy in California and now they're moving to New York and that's why they want to sell it? Well, if so, that's a legitimate reason. But without a very compelling reason, the auditors will likely disqualify it. But with that said, your clients can do whatever the heck they want, right? I'm not the tax police. I'm not the IRS. Your client doesn't even have to tell me how long they've held the property. But they better be prepared to defend the transaction if and when they get audited. And this is a really hard transaction to defend. Okay? Question number 2. Your client sold land and wants to 1031 exchange into 4 mobile homes. Is this allowed? No, it's not. Okay? Mobile homes are considered personal property unless they have a foundation. Ladies and gentlemen, if you can back your truck up to it and drive it away, it's not real estate. And when you do an exchange, you're selling real estate and you need to buy real estate. Okay? You don't buy personal property in a 1031 exchange. Okay, another question. Your client sold for $500,000 and they want to buy for $450,000. Is that allowed? First of all, absolutely. But what is done with the leftover $50,000? Well, client's got a few options, all right? Number 1, they pay taxes on the $50,000. Number 2, they use the $50,000 to go out and buy more real estate so they can pick up another cheap property out in Texas, or they go out and use the $50,000 to improve the new property in the construction exchange process that I mentioned earlier. All right, so I said, hey, the client has 2 options. They actually have 3. All right, that third option here with the construction exchange is a lot more complex. It's beyond the scope of today's presentation, but it is something that could be possible. Another question. Client would like to sell a rental and exchange into a primary residence. Is this possible? Absolutely not. When you do a 1031 exchange, you have to buy rental property. Everybody should know that. Now, you might be thinking, well, geez, what if? What if? No, no, no. All right, you need to buy a rental property. There is a case of a realtor who did an exchange, bought a property, and moved into it, got audited, and went to jail for tax fraud. Okay, so don't try to buy a primary residence with a 1031 exchange. You need to buy an investment property. Now, with that said, if you rent out the property for 2 or more years so that it qualified for the exchange, and then you want to move into it, that's possible. But absolutely, you need to rent the property out first for at least 2 years before you do anything else with the property. Another question. Client wants to sell 2 properties and exchange into 1. Is that possible? Absolutely, right? You're going to sell for $1 million. You want to buy 2 properties for $500,000 each. That works, right? As long as you're buying equal or greater in value, you can go out and you can buy 30 properties, like my one client that I mentioned did. All right, guys, we talked about the reverse exchange, right? That allows you to buy first and then sell. We talked a little bit about that. We're going to also real briefly talk about the construction exchange. You sell a property, you buy some land, you use your leftover dollars, your exchange dollars, to build on that land to get a nice property. Okay, these two exchanges, the reverse and the construction, they are difficult. They're more expensive and they're really challenging to finance. All right, so if you want to do a reverse or a construction exchange, you better make sure that you've got a really good lender, because Wells Fargo, Bank of America, all the big lenders don't like to loan on these type of transactions. So yes, they are possible, but very challenging to do. Ladies and gentlemen, that's it. All right, I'm going to answer a couple more questions that have popped up, but really what I want you to do from today's presentation is know the basics, which we've covered, but also put my phone number in your cell phone, because something's going to come up at some point. You're going to say, oh, geez, I took that class and I remember, is that possible? You're going to give maybe the right information to your client, but the best thing to do, just pick up the phone. We'll do a quick conference call. All right, so I'm available. My staff is available. This is our toll-free number. You can get us all the time. If you want to shoot me an email, you've got my email address here. So happy to consult with you guys anytime. Now, before we sign off here, I do want to answer a couple other questions. Lillian says, well, geez, I'm having a hard time getting the buyer's loan approved. Yeah, that's a problem. All right. If you have a 1031 exchange client and they can't get financing to buy the property, that's a huge problem. And you might need to go to a different lender, or you might want to ask the seller to finance the property. Elizabeth says, can we start to look into potential properties even before we closed escrow? Absolutely. So remember, Elizabeth, when you do your 1031 exchange, you have 180 days, right? But your exchange starts the day you close escrow. But guess what? You're going to be in escrow for usually 30 days prior to closing. A lot of my clients start looking and making offers on property way back here. And then they close right here on day 5. What you want to make sure, Elizabeth, is that you sell your property first and then you close, in that order. But absolutely go ahead and make offers way back here while you're in escrow to sell. Okay, Elizabeth says, can a seller purchase rental property and rent it to a family member? Absolutely. But the family member needs to be at least 18 years or older. The family member needs to be paying fair market value rent or close to it. And it needs to be legitimate, all right? Because if it's not legit, the government's going to sniff it out when you get audited, and you're going to have a problem. But you can definitely rent to Uncle Fred, right? You can rent to your 22-year-old college-age son and all of his buddies. But you want to make sure, again, it's a legitimate rental to an adult paying fair market or close to fair market value rent. And Lillian, you've got the very last question. Lillian wants to buy a duplex in her 1031 exchange and live in one of the units. Is that allowed? What do you guys think? Well, it depends. Lillian is going to sell $1 million property. So how much real estate does she need to buy to complete her exchange? $1 million worth of real estate, right? And $1 million worth of investment property. So if Lillian sells a property and buys a 2-unit building, the value of the rental unit needs to be worth $1 million. And if that happens, she can live in the rest of the property. All right. What Lillian cannot do is sell her $1 million property and buy a $1 million duplex and live in half of it, because then she's only renting out a unit that's worth how much? $500,000. So she sold for $1 million, and the value of the investment that she bought was only $500 because she lived in the other half. That doesn't work. You need to make sure that you replace the value of what you sold with equal or greater investment property. Not primary end investment, investment only. So can you live in your 2-unit building? It depends. How much did you purchase the 2-unit building for, and how much of that property is being rented out? If it's a $2 million property and you're renting out 50% of it, well, that works. Ladies and gentlemen, it is exactly 12:01. I am 1 minute late. I apologize. I like to start on time and end on time, but we got a lot of great questions today. We're going to go ahead and wrap up. I've got kids to take out to lunch right now, make some PBJs for my 6-year-old and 9-year-old because we're all working from home. And if you need to get a hold of me, you've got my contact information here. Ladies and gentlemen, have a great rest of your day, and I look forward to working with all of you soon.